Welcome to This Explainer. Today, we're making a massive mindset shift. We're moving away from that beginner's obsession with buying and dialing into a true professional secret weapon, the exit strategy. If you've ever, watched a winning trade slowly bleed into a painful loss or felt completely paralyzed when the market shifted, well, you are in the exact right place.
So let's just dive right in. When it comes to investing, whether we're talking stocks, crypto, real estate, you name it, beginners are usually absolutely obsessed with one thing. When do I buy? Or what is the absolute next big thing, right? But the pros, they focus on a far more crucial question. When do I get out? Entering financial markets with a ton of excitement but zero exit plan, well, it almost always leads to regret. You're either going to sell way too early and miss out on the major profits, or you hold on way too long and literally watch all your hard-earned gains just vanish into thin air.
To tackle that question, we're grounding our explainer today directly in our source material. It's a really comprehensive guide called When to Hold and When to Sell, a practical framework for exit strategy decisions. We're going to break down this exact highly practical framework so you can stop leaving your money on the table and actually start keeping your gains.
All right, here's our roadmap for today. We'll start by looking at the exit strategy problem, move right into the psychology of investing, and then cover setting clear profit targets. After that, we'll hit when to keep holding, warning signs to sell, and finally, we'll wrap up by building your personal exit framework.
Starting us off with Section 1, the exit strategy problem, and specifically, the profit illusion.
Now, most folks think investing is all about making money, but honestly, it's really about protecting it. Let's walk through a super painful but incredibly relatable scenario. Step 1, you buy an asset at $100. Step 2, it rockets up to $500. You feel like an absolute genius, right? Greed kicks in and you're convinced it's going straight to $1,000. But then Step 3 happens. The market reverses. It drops all the way down to $90. You end up with a net loss instead of a massive profit. Our source material heavily emphasizes that this isn't just bad luck. It's the predictable result of the profit illusion. That dangerous little trick where your brain assumes a rising price is just going to keep rising forever.
And that perfectly illustrates the massive divide between two types of market participants. On the left, we've got the emotional investor. This is the person who reacts to every little price swing, buys into random hypes, and relies purely on hope. Now contrast that with the strategic investor on the right. This is exactly who you want to be. They follow a plan, they use hard and fast exit rules, and, here's the kicker, they make all their critical decisions before the raw emotion of a live market ever hits them.
Moving on to Section 2, the psychology of investing, fear, greed, and the mindset shift. If investing was just about reading charts and crunching numbers, well, everyone would be rich. Your biggest enemy actually isn't the market at all. It's how your own brain reacts to it. Greed whispers in your ear to ignore your plan and hold out for more, while fear screams at you to panic sell during a totally normal dip. So please, burn this single powerful maxim into your brain. Selling is not failure, selling is control. Beginners so often feel like taking profits means they're quitting or missing out or giving up on a project they really believe in. We've got to completely shatter that myth right now. Selling means you are securing what you earned. It means you're taking risk off the table. It means essentially you are in the driver's seat.
So, the real trick here is learning to reframe profit-taking as an act of self-care. Rather than staring at a rising chart and stressing out, thinking, oh man, what should I do now? You need to stop and ask yourself one critical question. What would my future self thank me for? Think about it. Your future self is always going to prefer secured profit, reduced risk, and disciplined decisions over some emotional gamble that could literally wipe out your entire portfolio.
All right, let's get into Section 3, setting clear profit targets, deciding the exit before you enter.
Here is the core difference in strategy. Beginners try to figure out when to sell after they buy. But professionals, they lock in their exact selling points before they ever purchase a single asset. This leads us to a massive professional rule of thumb. Scale out, don't guess out. Look, the biggest trap for beginners is waiting to sell absolutely everything at the exact very top of the market. But spoiler alert, literally nobody knows where the top is. Scaling out completely solves this by removing the impossible pressure of trying to perfectly time the peak.
So how does scaling out actually work? Basically, you break your exit into planned stages. For instance, let's say your asset's price doubles. You might sell 30% of your holdings right there. Boom. That's target 1. If it keeps running up, you sell another 30% at target 2.
And then you hold on to that final 40% just to capture any remaining massive upside. By doing this, you've locked in real, tangible returns, you've drastically reduced your overall risk, and you've almost completely insulated yourself from the emotional panic of a sudden market drop.
The source material leans into this fantastic, really simple mental model for this, the farmer analogy. Picture yourself as a farmer planting a field of corn. You wouldn't just leave it in the field forever, crossing your fingers and hoping it grows infinitely larger, right? Of course not. You harvest it when it's ready. You store some, you sell some for income. If you just sit around waiting forever for maximum yield, the crop literally rots in the field and you lose the whole shebang. Taking profit is exactly the same thing. It's just harvesting your crop.
Which brings us to Section 4, when to keep holding, signs your asset has room to grow.
Okay, so we've talked a ton about selling, but let's be real, holding is equally tough. It causes so much anxiety. But strategic holding is based on hard evidence, not just blind hope. So how do you actually know when holding is the right move? Well, you look for these specific signals. Number one, the trend is still super strong, meaning the price is consistently making higher highs and higher lows. Number two, demand is visibly increasing. Maybe a ton of new users are joining the platform or trading volume is spiking. Number three, the fundamentals are unbroken. The team and the core purpose of the project are still totally solid. Number four, overall broader market conditions are positive. And finally, and this is a big one, your pre-planned profit targets just haven't been reached yet. If these boxes are checked, then holding is absolutely the correct data-driven move to make.
Let's flip the coin for Section 5, warning signs to sell, protecting your profit before it disappears. This is all about playing defense and protecting your profit before it just evaporates. Hesitating when the market suddenly shifts, that is exactly where retail investors lose the most money. So what are the giant flashing red flags that tell you to exit immediately? First up, parabolic price movement. If an asset just shoots up 80% in a matter of days, guys, that's usually totally unsustainable. It's a massive warning sign, not a guarantee of permanent wealth. Next is a loss of momentum, where those rapid gains suddenly start slowing down. Then you might see lower highs popping up on the charts, which essentially means the buyers are just getting exhausted. Also, watch out for negative news or structural changes that totally ruin the original reason you bought the asset in the first place. And finally, the absolute ultimate signal. Your planned profit target is reached. When it hits that target, you sell. Period. No debate, no second guessing.
And now for our final piece, Section 6, your personal exit framework, the ultimate blueprint.
We're going to pull all these lessons together right now into a tangible, actionable template. This is something you can literally apply to your very next trade. Check this out. Before you buy anything, you write this down. First, you note your exact entry price. Then, you clearly define the exact price for target 1 to secure that initial profit. You define target 2 to lock in deeper gains. You define your final target. And crucially, absolutely crucially, you define your stop loss. That's your financial emergency exit if the trade immediately goes against you. Doing this one simple exercise completely rips the emotion right out of the investment life cycle. If your written plan says sell, you sell. If it says hold, you hold. It's really that simple.
Now, as you're putting that plan together, here's a really quick psychological test to see if you're ready. It's called the 50% rule. I want you to ask yourself directly right now, if the asset I'm about to buy drops 50% tomorrow, will I still hold it confidently? If your gut reaction is no way, then guess what? Your position size is way too risky, or your entry is purely emotional rather than strategic. You've got to adjust that before you hit the buy button.
And that brings us to our final, somewhat provocative thought for this explainer. If the market crashes tomorrow, are you going to be a victim of hope, or are you a master of your exit? Because at the end of the day in investing, the people who survive long enough are the ones who eventually win. So it's time to adopt that survival mindset. Stop endlessly waiting for the absolute perfect top and implement your structured exit strategy today.